Welcome to part 11 of our financial statements video training. In this video, we demonstrate how the income statement and the balance sheet are connected. Please print the PDF handout shown below this video as it will be used throughout the training.
Let's now move on to the handout that says Relationship of Balance Sheet and Income Statement. I put together this very simplistic exhibit hoping to show the relationship between the income statement and the balance sheet. We want to show how a revenue is going to change stockholders' equity, because accountants don't really post revenues directly to stockholders' equity. They post them to a revenues account. So let's track through how a sale on credit is going to change the balance sheet for the company. So we're going to start with the top left balance sheet there. It shows that the corporation must have just started. There's $10,000 of cash and the common stock is $10,000. So the owner must have put in $10,000 and we issued shares of stock. On the very next day, on January 2nd, the owner provided a service to a client on credit. And on credit means the client doesn't have to pay for 30 days perhaps, right? But under accrual accounting, the owner earned $50 because the owner did the service and has a right or a receivable for $50. So we're going to make up an income statement for just one day. So for the day of January 2nd, we see revenues of $50. Why? Because the owner earned the fees by delivering a service, performed a service, had no expenses. So the net income for this day was $50. Now that $50 is going to be recorded in two places. Accountants have a procedure that's more than 500 years old, and that is that we do double entry accounting. So for every transaction, there's going to be two effects. Two accounts are going to be affected by every transaction. In this transaction, we know that service revenues are going to be affected, and we know that revenues causes stockholder equity to go up. So that's one. The second is that the company is going to have an account receivable for $50. Right? So the two effects are, one, there's an asset created for $50, the receivable, the right to get that $50 from the client. Client didn't pay, but they'll pay eventually, is the assumption. So we're going to record an account receivable. When you look at the balance sheet now, that's the bottom sheet, the bottom balance sheet, you'll see that accounts receivable now shows $50 and total assets went up to be $10,050. Now that balance sheet has got to remain in balance, just like that the accounting equation had to be in